Let's head on back to slide 22. Slide 22 shows the classifications of what we're discussing. We already discussed number one, measuring the ability to pay current liabilities. That's the working capital, the current ratio, and the quick ratio. And we just finished up looking at turnover and cash conversion cycle. The next classification is overall ability to pay debts, leverage. Okay, so we'll head on to moving back to slide 34, and that is overall ability to pay debts. The two ratios we're going to be looking at, the debt ratio and times interest earned. The debt ratio expresses the relationship between total liabilities and total assets. A ratio of 1 indicates that debt has financed all assets. A higher ratio equals greater pressure to pay interest and principal. So when we're looking at debt ratio from the perspective of how much risk that the company is taking on, the higher the debt ratio, the more risk. The debt ratio is computed by taking total liabilities and dividing it by total assets. So let's move back to slide 11, and we'll use that as the example. When we're looking at the Under Armour Incorporated consolidated balance sheets, we'll look for total liabilities first. The total liabilities are actually on slide 12. Total liabilities for the year ending 2016. So we'll go ahead and plug in total liabilities, 1,613,431. So we'll plug into our formula here on a spreadsheet, $1,613,431. Now we're going to divide that by total assets. We'll go back to our balance sheet, slide 11. We'll go back to slide 11. Total assets is listed on row 14. So it's 3,644,331. So this is pretty easy computation. We'll take total liabilities and we'll divide that by total assets. And it's usually represented in terms of a percentage, rounding to the nearest hundredths of a percent, 44.27%. What this is saying is that of the total assets, 3,640,000, actually this is 3 billion, right? 3,644,331 of the total assets, 1,613,431,000 is financed through the debt. That's 44.27%. Moving back up to slide 36, the next ratio is times interest earned, and the first bullet point says measures number of times operating income can cover interest expense. One is going to feel more comfortable if a company generates enough income to pay the interest expense over and over and over again. You know, the more times it can, the more comfortable an observer might be. A higher ratio indicates ease in paying interest. If you have the income, you should be able to pay the interest, right? A low ratio indicates difficulty in paying interest. So we're going to look at this computation times interest earned ratio is equal to income from operations divided by interest expense. So plugging the formula into the spreadsheet, we'll see times interest earned is equal to income from operations divided by interest expense. Go to slide number 10. Slide number 10 shows the Under Armour Incorporated consolidated net income. And we scroll down 2016 and look for income from operations. And that represents for 2016, 417,471,000. So we plug the 417,471. Then we look for interest expense. Interest expense is in 2016, 26,434,000. So in this example here, we'll take the income from operations. We'll divide that by the interest expense, and we end up with 15.79 times. And just as we described earlier, that 15.79 represents the number of times operating income can cover interest expense. So the higher the better. This is pretty decent, where we feel pretty comfortable that enough income is being generated to cover its interest expense. Okay, moving on to slide 37. The next category of ratio analysis is measuring profitability. And so there's quite a bit of computations we can look at here. There's the gross profit margin percentage, there's the operating profit percentage, the DuPont analysis, which then lets us look at rate of return on sales, asset turnover, rate of return on total assets, leverage ratio, rate of return on common stockholders' equity, and earnings per share of common stock. The first thing we're looking at is gross profit margin percentage, and this amount of profit entity makes from merely selling its products before other operating costs are subtracted. So what we're looking, the gross margin percentage is equal to the gross margin, this is a dollar amount, divided by net sales. Both of those numbers are going to come from the income statement. Gross margin and net sales. So let's go ahead and scroll back to slide number 10. Now here it's listed as gross profit. When you see gross profit and gross margin, those are really, they're used interchangeably, they mean the same. So this is 2,240,611,000. So let's plug that in here. It's 2240611. And net sales comes from the same income statement, or consolidated net income. Net sales and net revenues are the same. 4,825,335,000. So now we have the numbers we need in order to do the computation. 22,40611 divided by 48,25,335. This is usually listed as a percentage, maybe to the nearest 1/10 of a percent. So the gross margin percentage in this case is 46.4%. After computing the gross profit margin percentage, we move to the next, operating income profit percentage. This is measures the percent of profit earned from sales dollars in a company's core business operations. So this is a pretty straightforward computation as well. Operating income percentage is equal to operating income divided by net sales. So here's our formula again, and we'll go ahead and move our PowerPoint slide to slide number 10. What we're looking for is operating income. In this case, it's income from operations, 417,471,000. And we're going to divide that by net sales. And we've actually looked this up already, so 4,825,335. Operating income divided by net sales will equal 8.7%. Now, this is just like any other computation, even the ones we've done just a bit ago. By themselves, they're not very meaningful. We'd have to take this number and compare it to others in the same industry and make a determination as to whether this company is doing well relative to the other companies. Okay, so we just finished the operating income percentage, and now let's move on to the next. The DuPont analysis takes a lot of different ratios and brings them all together. So we'll look at this, but we're actually going to do the computations for each one of these anyway. ROA, return on assets, times the leverage ratio, which is really also referred to as the equity multiplier, is equal to ROE. Now, the DuPont analysis demonstrates how all of these ratios can relate with one another. And let's look specifically at ROA. That can be computed by taking the return of the rate of return on sales, which is the net profit margin, multiplied by asset turnover ratio, multiplied by the leverage ratio equity, which equals the return on equity. So on the surface, it looks like we've just carried over these and defined them a little bit better. But even when we get to when we say rate of return on sales, what is that? That's net income divided by net sales, which is going to be multiplied by the asset turnover ratio. Well, the question is how do we come up with that? That ratio is computed by taking net sales and divided by average total assets. And then we'll multiply this by the leverage ratio equity multiplier. The way we compute that is taking average total assets and dividing it by average common stockholders' equity. And then whatever this amount comes to, it actually equals net income divided by average common stockholders' equity, which is really the ROE. Now you can see how this becomes pretty obvious. What it equals, the ROE in this formula, becomes pretty obvious when we're looking at the three terms that are listed on the left side of the equation. If we remember how to take multiplications that are fractions and then simplify, you could see that net sales and net sales will cancel one another out. Average total assets and average total assets will cancel out as well. And what we're left with is net income divided by average common stockholders' equity. And that's exactly what ROE, that's how we determine what ROE. So let's take each one of these independently and compute them. The first one is the rate of return or net profit margin. This shows the percentage of each dollar sales earned as net income. The higher the percentage, the more profit being generated by sales dollars. Same thing, the number by itself is going to be almost meaningless. We do want to make sure that we take this number, whatever the computation is, and compare it to others in the same industry. So let's go ahead and plug this formula into a spreadsheet. And we have it listed here, net income minus preferred dividends divided by net sales. Let's go back to our slide number. Net income is the bottom line number, 256,979,000. That's the bottom line number. And we're going to divide that by net sales, which is also net revenues, 4,825,335. 256,979 divided by 4,825,335, 5.3%. So what this is saying that for every dollar in sales, we're getting 5.3 cents return. For every dollar in sales, we're generating 5.3 cents of income. Okay, so let's take a look at our next ratio, asset turnover. This measures the amount of sales generated per dollar invested in assets. It measures how efficiently management is operating the company. The asset turnover ratio is computed by taking net sales and dividing it by average total assets. So we plug in the formula here to the spreadsheet. Asset turnover ratio is equal to net sales divided by average total assets. So to use a specific example, we'll go to slide number 10. And we need net sales, which is the same as net revenues. Row 3, 4,825,335. 4,825,335. Now we've got to compute average total assets. So before we go any further, let's go ahead and compute average total assets. And we've done something similar to this before. When we've computed average inventory, we computed average receivables. And we will do it in the same way. The average total assets is equal to the ending balance plus the beginning balance. And that's going to be divided by 2. So we go to the balance sheet. as of December 31st, 2016, and we look at total assets, the ending balance is 3644331, and the beginning balance, which is equal to the prior year ending balance, was 2865970. And we add those two together, and that number is then going to be divided by 2. So total average assets will be this divided by 2. So let's go ahead and put a little box around here so we know this is focused on computing average total assets. Average total assets, here's what we came up with. So we're going to plug in that number here. That number is going to be 3255151. And that means then if we want to do the computation for asset turnover, we take net sales, and we're going to divide that by average total assets. And we come up with 1.48. So with every dollar we've invested in assets, we're generating $1.48 in sales. Is that good? Depends on how it looks compared to the industry. So asset turnover ratio equals 1.48. All right, so we got the asset turnover computed. The next we're going to look at is the rate of return on total assets, or the ROA. That measures how profitably the company uses its assets. Pretty similar to the previous computations, but instead of using net sales, we're using rate of return on sales. The way we compute the ROA is we take the rate of return on sales multiplied by the asset turnover ratio. So we plug in the formula into the spreadsheet, and now we're looking at ROA is equal to the rate of return on sales. We already computed this previously. Rate of return on sales was 5.3%, and that's going to be multiplied by the asset turnover ratio, which that was already computed as well. That was the one we just computed. So we'll take 5.3% and multiply it by 1.48, and that gives us 7.9% rounded to the nearest tenth of a percent. Okay, so I think we've actually finished one of the main computations for the DuPont analysis, ROA. That's what we just finished. We computed net income divided by net sales, which is the return on sales, and we just multiplied it by the asset turnover ratio, which we had done that. So we have the ROA now. We're going to multiply that against the leverage ratio equity multiplier, which is this computation, average total assets divided by average common stockholders' equity. So let's confirm that. We'll move forward back to where we were. So here's the ROA we just computed. Now we're moving to the next slide, slide number 44. And the equity multiplier measures impact of debt financing on profitability, and it shows the proportion of each dollar of assets financed with stockholders' equity. The way we compute it is we take average total assets, and we divide that by average common stockholders' equity. Here's the formula now in a spreadsheet. Leverage ratio is equal to average total assets divided by the average common stockholders' equity. Well, the good news is we've already computed average total assets. So let's go and just look for that number that we've already done. Average total assets, 3,255,151,000. And that's going to be divided by, we have not computed average common stockholders' equity. So we have to figure out, well, how do we compute that? Well, it's the average. So we're going to take the ending balance, we're going to add the beginning balance, and then we're going to divide it by 2. We're talking about common stockholders' equity. So let's do that. Beginning balance, using the numbers that we're working with. Slide number 12. Total stockholders' equity. Ending is 203,900. Beginning balance is 1,668,222. Continue with our computation. 2 added together is 3,699,122. So we take this, divided by 2, and our average balance for common stockholders' equity is 1,849,561. So we'll move that up here, a little box around this so we don't get confused. So now we have both numbers. We have 322,151. Divide that by 1,849,561. And that's going to give us 1.76. So we've computed the leverage ratio of 1.76. The next slide then asks us to compute the ROE, the return on equity. And that is computed by taking net income minus preferred dividends divided by average common stockholders' equity. Now, when we look at the balance sheet, there is no reference to preferred dividends, none. So therefore, we assume that there are no preferred dividends. Since there's no preferred stock, there's no preferred dividends. So we can plug a 0 in for that. And then that's going to be divided by average common stockholders' equity, which we've computed that as well. So ROE, the rate of return on equity, is equal to net income minus preferred dividends. That's going to be divided by average common stockholders. So I think we've already computed net income, and there's no preferred dividends. So when we're computing the rate of return on sales, it was net income minus preferred dividends. I don't know if I mentioned it then, but since there are no preferred stocks listed in the stockholders' equity section, then we can assume that that's 0. So we already computed this, which was 256,979. We'll go ahead and divide that by the average common stockholders' equity, which we just computed that in the previous computation, which was 1,849,561. And so our ROE is computed by taking that computation, and that comes up to be 13.9%. So same thing, 13.9%. I really can't tell you whether that's good or that's bad. We'd have to take that number compared to others in the same industry. Okay, so we finished the ROE. Let's move on to the next. What we have is EPS, the earnings per share. This is the amount of net income earned for each share of outstanding common stock. It is most widely used ratio, particularly with investors when they're trying to see how good an investment is. They often use the EPS as a way of measuring how well that stock is performing. The EPS is computed by taking net income minus preferred dividends and divided by the average number of common shares outstanding, average number of shares of common stock outstanding. Okay, so net income minus preferred dividends. Net income, we know preferred dividends is 0. We've already done this computation, so 256,979. This one can be the average number of common stock outstanding can be a little bit tricky. Let's see if we even have enough information. Let's see if we have enough information in our balance sheet too. No, we actually do not. It says common stock. If it would give us a par value, and then let's say it's $1 par value, then we would know that we have 145,000 outstanding shares. Let's just assume that it's 145,000. And since we're looking at average, we would take this plus this and divide it by 2. So 145,000 plus 144,000 Divide that by 2 gives us 144,500. So we'll take this, we'll divide it by that, and we'll end up with $1.78. So this company is generating $1.78 of earnings for every share that's outstanding. Okay, so that completes that computation. The next set of ratios is looking at analyzing stock investments. Two pretty simple computations that we can look at. The first one is the price-earnings ratio, and the next one is the dividend yield. So let's take a look at the first one, which is the price-earnings ratio, PE ratio. That shows the market price of $1 of earnings. It appears in the Wall Street Journal stocks listings, and it's abbreviated P/E PE ratio. Okay, so PE ratio is equal to the market price per share of common stock divided by earnings per share. Now the good news is we've already computed the earnings per share, so all we need to do is come up with the market price. Well, let's go ahead and plug that in. So now we have the formula. PE ratio is equal to the market price per share of common stock divided by EPS. And so let's go ahead and plug these numbers in. Now the market price per share, that's going to have to be given. I mean, there's just no way it can be computed. It's just going to have to be given. I'm going to make something up. Let's just say we have a $100 market price per share. We're going to divide that by the EPS, which we did compute that. So we have a reference here. So we'll take $100 and divide that by $1.78. So the PE ratio in this example is 56. Same thing, we're going to have to compare that. The good thing about the price-earnings ratio is that's something we could actually use across industries. It's not specific. It's taking numbers that are just kind of generic. So if you're looking at two investments in different industries, this might be one that you want to take into consideration. And then the next ratio, dividend yield. This measures the percentage of a stock's market value return annually to stockholders as dividends. And in this case, we're looking for companies that actually generate a high dividend yield if we want to have dividends paid to us. If we're looking for steady type income, you know, when we retire, as an example, we're looking for investments that are going to generate a steady stream of payments or income. So we're looking for, in that example, we're going to be looking for companies that pay a good amount of dividends out. So that helps us with our cash flow. All right, let's go look at this. We'll go ahead and plug this in. Dividend yield. Okay, so on our spreadsheet, we have the dividend yield on common stock is equal to the dividend per share of common stock divided by the market price per share. We'll go ahead and use what we used before. Market price per share, $100. That's going to have to be given, so that's not anything that we could look up on a financial statement. And then this would actually have to be given as well. So let's assume that they pay out an average of $10 per share. And so then our dividend yield will be computed by taking 10 divided by 100, and that's going to give us a percent. And this is 10%. Is that good? This really depends on the industry, and this also would depend on whether we're looking for a company that pays quite a bit in dividends. If that's our objective to gain cash flow, then we would be looking for this. When we use these ratios, we do have to understand that there are some limitations. And specifically, the first bullet can indicate something is wrong, but not pinpoint what the problem is. So we could see that maybe somebody is, maybe their, let's say their average number of days of collections or number of dollars sales outstanding per day. Let's say that is relatively high. Well, that tells us that there's a problem, but it doesn't tell us specifically what the problem is. It just gives management a direction to go out and see, you know, here's where we need to focus on. We try try to analyze what's going on. The next bullet point, legislation, international affairs, scandals, and other factors can turn profits into losses. Economic conditions, you can see the pandemic is really, especially for travel companies and even entertainment businesses are really struggling right now. So kind of tough to see those sometimes coming. The third bullet point should be analyzed over a period of years to consider all relevant factors. And then the last bullet point always involves uncertainty. That's the nature of business. We just don't wish, if we could predict everything, then everybody would be millionaires, but we can't do that.